Greetings, this is Manu Walia from Continuum Global Asset Management. Today is the end of third quarter, September 30th, 2022, and we're going through some tough times in the market this year. The NASDAQ index has been down 33% year to date. Dow and S&P are down about 20% each, a little more than that. And this whole thing started with our friends at FOMC, Federal Open Market Committee, who have started to raise rates because they want to control inflation. And, we can't really blame them. And we can't say that they're doing something wrong because their mandate is to control inflation and look out for employment. As we know, employment is really, really good since the March of 2020, which was the beginning of COVID. Unemployment back then was about 10% because there was a shutdown. And since unemployment has gone down to about 3.4, 3.5%, which is a multi-decade low. So that's a great thing. But on the other hand, because the federal government infused so much money into the markets of various programs that created a lot of inflation, and the geopolitical problems with Ukraine and Russia haven't really helped. And on top of that, the problems with China, and when I say problems, because they've been a lot more stringent with COVID than any other country, that they're still going through some shutdowns, and a lot of their production has been hurt because of that. So if you take all of these factors together, it ties directly into a higher inflation. So despite the fact that over the last couple of months, inflation in my mind has come down a bit, gas prices are down, some areas of food are down a little bit. The federal government is still very, very strong and in the camp of raising rates for another, I would say, 3 to 6 months. Their terminal rate, or the Fed fund rate, where they believe that they'll stop raising rates, is about 4.5%, a little higher or lower. That means that they may raise rates 2 more times and then look at the data and see if they want to put the brakes on their policy to raise rates. In the interim, what's happened is the markets have lost a lot of confidence in the federal government and their policy decisions, and more institutional investors / economists believe that we're going to go through a recession. That very well could be. And I'm not here to speculate on recession. What I'm here today is to talk about the technical indicators that work and have sort of impacted the market in the past. So like we say, history doesn't repeat itself, but it does rhyme. So I'm going to quickly go over 4 or 5 very important psychological factors and how we can look at them as contrarian indicators. So let me go ahead and go through this list. The first one I want to look at is the volatility index, or the fear gauge. The second is, as you can see, AAII, which stands for American Association of Individual Investors. I want to look at their sentiment. The third factor is the consumer sentiment, which is conducted by the University of Michigan, of how consumers are feeling in the prevailing conditions. The fourth factor is the S&P 500, and what is the future projection or the price earnings ratio on the S&P 500. And lastly, I think one of the most important areas to consider is the involvement of the Federal Reserve over the last 100 to 120 years, and what that does to the economy, the U.S. economy / capital markets. So let me move on to our first indicator, which is the VIX index. So very quickly, the VIX index is comprised of short-term puts and calls or options on the S&P 500 index. So without going into the formula or how these or how this index is calculated, I just want to focus on the fact that there's an inverse relationship of the VIX with the S&P 500. As you can see, every time the S&P, which is the blue line at the top, has gone down or taken a sort of a plunge, the VIX index has gone up. So you see this is back in 2018, this is back in 2019. So again, there was a correction in the market and the S&P, the blue line comes down, the VIX index goes up. Again, at the current levels, we can see that the markets have gone down. The S&P is down about 20%. And this is actually in COVID. Markets were down about 30% in less than 2 months. And look at the spike in the VIX. So if this is of some indication that the markets bottom at these levels in the mid 30s on the VIX, I'd like to bring to your attention that the VIX is currently trading at about 32 or 33. That's very, very high, and there is extreme fear in the market. So I believe that when you have something like that, everybody is running to the hills, everybody is going out and buying insurance on their portfolios in the form of buying puts on the S&P, which says that there's extreme fear, which means we might be close to the bottom. Something to think about. The next indicator I'd like you to look at is the aggregate sentiment of the individual investors. So to quickly put this in perspective, the AAII Association does this weekly survey of American individual investors, and they ask them, how do you feel? Do you feel positive, negative, neutral, what have you? So on an average, the sentiment, there's a line right here in the blue line between the blue, which is the average sentiment of this survey, a weekly survey, and that's around 38 on their measure. 38% of the people surveyed are bullish on an average. Currently, there's only about 16 to 17% bullishness on the AAII sentiment. Again, historic data shows that when you've had such extreme sentiment on the downside, the next 12 months markets have gone up north of 20%. Again, this is just based on a 3,000 to 5,000 sample data of individual investors. You can see whether this is very accurate or not, but it's up to you. It's a contrarian indicator in my mind. When the herd is going one way, you know that there's extreme fear, and that's a contrarian indicator that might signal a buy signal. The third indicator is consumer sentiment. How do consumers feel about the overall economy? And this survey comes from the University of Michigan. Again, this is no different. They go out and do a sample analysis. And as you can see, at each recession, the survey shows that consumer sentiment is at an extreme low. And eventually the markets actually go up quite a bit. If I could read this correctly, it says that during the troughs, which is a downside, if you would have bought the markets on an average were up about 24%. It's a 12 months post a low. So currently, as you can see, this is basically April of 2022, and down in August, we are somewhere down here, which is an extreme negative bearish sentiment. 62 or 63% of the people surveyed were bearish. Again, this is a contrarian indicator. To me, it signals buy. The S&P 500 forward PE based on earnings for next year. Some people will argue that this is more of a fundamental variable, but I think that PE ratios at any period of time show us sort of the sentiment, sort of the appetite of investors for the earnings of the S&P 500 companies, which I believe is the broadest and the most followed index. So currently, a lot of economists are discounting earnings for the next 12 months. Understandable, the markets are going, not the markets, but the Wall Street / Main Street going through some turbulent times, which will definitely come into the economy. And if there is a slowdown, that's going to bring earnings down. At lower earnings, about 15 to 20% discount from last year's expectations, we are looking at a price earnings ratio of between 14 and 15. Now, I cannot make a case that this is a very compelling buying opportunity, but I can see that the price earnings ratio or the valuation of the S&P 500 is close to its average for the last 30 years. So again, from this point of view, because of the losses in the market, it may be a good time to start building a list of stocks or investments that you like for your portfolio, and you'll be handsomely rewarded over the next 2 to 3 years. Lastly, and I think more importantly, I'd like to talk about the Federal Reserve and their involvement with the U.S. economy / capital markets over the last 150 years. We started with Federal Reserve, FOMC, the Federal Open Market Committee, which is comprised of 12 members, each president of a Federal Reserve Bank in the United States, and how they've played a role over the last so many years. So Federal Reserve played a very important role back in the major depression that the United States experienced in the 1920s, the 1929 market crash, and the recovery, which took more than a decade. So if you look at this chart, what I'm trying to show is that before the 1929 crash, and again, we can look at it this way, if we compartmentalize this chart, prior and post, you will see that these gray lines are a lot more thick and a lot more than the gray lines post 1929 depression. In other words, the involvement of the Federal Reserve and their policies has actually helped with fewer recessions, and the length of those recessions have been very, very small. Well, I wouldn't say very small, but relatively small when they were not that involved with the US economy. So based on these variables, the inference that I can make is we don't know whether we're going to see or are already in a minor recession. We don't know if there's going to be a repeat of 2000, 2001, 2002, 2008 or 2009, and if there's going to be a huge crash. But historically speaking, in major recessions, markets are down anywhere between 25 and 35%. NASDAQ has already lost 33% this year. The S&P and the Dow Jones are down about 22 to 23%. So what I'm saying is, from a technical perspective, it makes a lot of sense to start to look at investments that you like or would like to own for the long period and start to buy them and start dollar cost averaging. We may go down another 5 to 10%. I don't know. I don't have a crystal ball. I don't want to evaluate and make predictions on that. But I do know that historically speaking, if you buy when everybody is selling and sell when everybody is buying, that's the recipe for economic fruition. I will leave you with that thought, and please feel free to call us or email us. You can get all that information at www.cgamadvisor.com. And my name is Manu Walia, and thank you for listening.